At Insightful Value, we look beyond the headlines and into companies you actually recognize, like the one behind your favorite late-night meal. Nissin Foods, the creator of instant noodles, has seen its stock price dip lately, but is this just market noise, or does it hint at a deeper opportunity? This video is for informational and educational purposes only, not financial advice. If you're into finding real-world companies trading below the radar, hit that like button and subscribe to the channel. Nissin Foods is a household name in Asia and increasingly global. Based in Japan, it's the company that basically invented instant ramen back in the 1950s. Today, its brands like Cup Noodles and Top Ramen are sold across more than 80 countries. But despite its iconic status, the stock has been sliding recently, especially since early 2024. So what's going on? Let's unpack it. Nissin's business model is simple but powerful. Low cost, high volume, globally distributed food products. In the last fiscal year, the company generated over 700 billion yen in revenue, with operating margins sitting around 10%. Its overseas business, particularly in the United States and Brazil, has been a major growth engine, helping to offset the more mature domestic market in Japan. Nissin has also invested in plant-based foods and health-conscious variants of its products, aligning with shifting consumer trends. Still, the stock market hasn't been too kind lately. Investors have concerns about rising input costs, especially wheat and oil, which impact production and logistics. In addition, foreign exchange volatility has affected earnings translated from overseas operations. The latest earnings report showed some margin pressure, although revenue remains relatively stable year over year. From a value perspective, Nissin now trades at a lower earnings multiple compared to its 5-year average. That could indicate an entry point for long-term investors, especially considering the company's consistent profitability and brand power. The dividend is modest but dependable. Nissin has increased its dividend gradually over the years, and its payout ratio remains conservative, signaling room for further hikes if earnings recover. But this isn't without risks. The food industry is hyper-competitive and low margin. Supply chain disruptions, changing regulations, and evolving consumer preferences can all eat into profits. Nissin's exposure to emerging markets like Brazil is both an opportunity and a vulnerability, depending on currency and economic swings. And while brand loyalty is strong, it needs to keep innovating to stay relevant to younger consumers and changing diets. So why consider the stock now? Because the current valuation assumes the worst, while the fundamentals remain intact. Nissin is still highly profitable, still innovating, and still distributing a product that has global demand, even in economic downturns. It's defensive, cash-generating, and internationally positioned. That's a profile many investors overlook when the spotlight is elsewhere. At Insightful Value, we specialize in digging up these types of stories, companies with real earnings, strong brands, and a misunderstood narrative. We take the jargon out of stock research and give you what matters. For more in-depth analysis on Nissin and other undervalued businesses, check out insightfulvalue.com. And if this kind of analysis is your thing, don't forget to like the video, subscribe to the channel, and visit insightfulvalue.com for more.